A family tours a modest home. The agent smiles. The price is final. They do not know who they are really bidding against. Not a neighbor, not a couple moving from across town, but an institution. Capital so large it does not shop for houses. It shops for markets. Because in modern finance, homes are not just places to live. They are yield. They are cash flow. They are spreadsheets that pay rent every single month. And one firm helped industrialize that idea at global scale: Blackstone. This is the story of how Blackstone turned real estate into a global cash machine, and how the logic of private equity quietly reshaped what owning a home even means. Most people think wealth is built by owning things. But the biggest players do not just own, they structure. Private equity is not a company, it is a machine. Here is the simplified version. First, capital is raised from institutions, pension funds, endowments, sovereign wealth funds. Second, that capital is used to buy assets, companies, buildings, infrastructure. Third, cash flow and pricing power are improved. Fourth, the asset is sold, refinanced, or packaged, and along the way, the machine gets paid. Management fees, performance fees, transaction fees. In other words, the system earns money for operating, not only for winning. Now apply that logic to real estate. Real estate has three ingredients finance loves. It is tangible and collateralized. It produces predictable monthly cash flow, and it can be scaled and standardized. One landlord becomes a platform. One building becomes a portfolio. Blackstone did not invent real estate investing, but it helped modernize it into something bigger. Real estate as a global yield product. After major financial shocks, something predictable happens. Assets are mispriced, liquidity disappears, and whoever has capital gains power. Blackstone built its reputation by moving when others could not, buying when sellers were forced. Then a new idea took over the industry. If you can buy enough housing, you can treat rent like an index. A single house is risky. 10,000 houses are a portfolio. At that scale, you do not operate like a landlord. You operate like a logistics company. Maintenance is centralized. Renovations are standardized. Pricing is dynamic. Occupancy is optimized. Data replaces intuition. The more you scale, the more you learn. The more you learn, the better you price. The better you price, the more you scale. This is where finance becomes culture, because housing is emotional, but capital is not. Capital asks one question: what is the annual yield, and how stable is it? Once housing becomes yield, the market behaves differently. Here is what most people miss. The profit is not only in buying low and selling high, the profit is in optionality. When a firm owns massive real estate portfolios, it can choose. It can hold and collect rent. It can refinance and extract cash. It can sell portions for gains. It can package cash flows into financial products. That flexibility is power, but the most underestimated part is boring. Financing. A small investor borrows at retail terms. A global platform borrows at institutional terms. Cheaper capital, better conditions, more flexibility. So the machine compounds advantages. Cheaper money, operational leverage, data advantage, negotiating power, diversification. All of it leads to one outcome: predictable cash flow at massive scale. That is why real estate became a core pillar of modern asset management. Not because it is exciting, because it is repeatable. Now, the uncomfortable part. Housing is not just another asset. A home is safety, identity, stability. When large capital flows into housing, side effects appear. Competition increases, prices rise, policies become standardized, relationships change. Not every city is the same, not every investor behaves the same, but the pattern is clear. When homes become yield, markets start serving yield, and once systems are built around yield, they rarely reverse. So what is the lesson here? The winners are not always the best predictors. They are the best designers of systems. You cannot outscale institutions, but you can learn from their logic. Focus on resilient cash flow. Diversify income, not just assets. Avoid fragile leverage. Build simple systems you can repeat. At every level of wealth, the objective is the same. Build a machine that produces cash flow and make it hard to break. In the modern economy, wealth is not just owned, it is engineered. And the firms that engineer it best quietly reshape the world around them.